Tactical asset allocation involves making short-term adjustments to portfolio allocations based on current market conditions, economic trends, and asset class performance forecasts. This strategy allows investors to capitalize on short-term opportunities and manage risks during market fluctuations while maintaining a long-term focus through strategic asset allocation. By integrating TAA with SAA, small apartment investors can enhance returns and mitigate risks without deviating from their core investment objectives. Key concepts in tactical asset allocation. What is tactical asset allocation? Well, TAA is the process of temporarily overweighting or underweighting specific asset classes or sectors based on short-term market forecasts. Dynamic adjustments involve frequent changes to allocations in response to economic data, interest rate movements, geopolitical events, or market sentiment. So, the main goal here is to enhance portfolio returns or reduce risk by aligning with prevailing market conditions. Now let's talk a bit about the benefits and challenges of TAA. Alright, let's talk about the benefits. Opportunistic returns mean that tactical asset allocation seizes short-term opportunities in outperforming asset classes. There's also risk mitigation since it shifts allocations to defensive assets during periods of market uncertainty, and, flexibility is key. It allows for quick adjustments to changing market dynamics. Now, there are definitely some challenges to keep in mind. First, there's market timing risk. Misjudging market movements can actually lead to underperformance. Then, higher costs come into play, because frequent transactions increase both trading costs and tax liabilities. And not to forget the complexity, this approach really requires advanced market analysis and constant monitoring. So, how do you integrate tactical asset allocation with strategic asset allocation? Well, the long-term focus is important. Strategic asset allocation establishes the foundational portfolio allocation based on your long-term objectives and risk tolerance. Then, tactical asset allocation overlays on top of that, making short-term adjustments to leverage current market opportunities. Striking the right balance is crucial. You want to maintain your core allocations while using a small percentage of the portfolio, say around 10 to 20%, for tactical adjustments.